Well, thank you, Chairman Staff Schultz and members of the Senate Committee on Financial Institutions and Sporting Heritage. Thank you for allowing me to submit testimony today on SB 832 relating to payday loan reform. According to the most recent 2023 annual report by the Wisconsin Department of Financial Institutions, the average annual interest rate, including fees and charges, for payday loans was 867%. That's really high, 867%. Of the 3,743 payday loans issued, only 49% were repaid in full. That's a really high default rate. I heard the story of one person who took out a $500 loan and eventually defaulted after paying over $6,000 in interest. They were unable to pay off the principal balance, but paid a heck of a lot of interest. One of the unique features of payday loans under current law is the requirement that the customer must pay back the loan in full at the end of the very short term. This is unlike mortgages, car loans, boat loans, home equity lines of credit, or other consumer loans, which all have a payment plan where part of your payment goes toward paying down your principal. In the past, legislation has been offered that would cap interest rates. This bill does not do that. The interest rate caps have historically been opposed by banks and credit unions as a slippery slope of government interference. In this case, banks and credit unions have shared with us that they have no opposition to this bill. In fact, the Credit Union League even registered in favor of this bill. This bill would change the rules for payday loans so that they would resemble other loan types. In essence, they become short loans for 90 days to not more than 6 months, with pre-computed payments that must have a portion going to principal. This short length would still have payday loans playing a unique role in the market, while also allowing consumers to be consistently paying down debt. The bill would also require payday lenders to evaluate the buyer's ability to repay and to disclose the amount of interest that will be paid over the course of the loan term, along with the amount of each payment. Finally, the bill also requires that payday lenders disclose to the applicant the availability of a basic financial literacy course that the Department of Financial Institutions would create. I'm grateful, by the way, for the input of DFI to help make technical corrections to the bill addressed in the substitute amendment. The substitute amendment clarifies how interest would be calculated and ensures that the principal reduction was a part of each payment. The substitute amendment also makes changes to the definition of payday loans, in essence to avoid accidentally creating a loophole for payday lenders to operate without government oversight at all. Included with my written testimony is testimony of several Wisconsin residents that have been harmed by the predatory effects of current law payday loans. While payday loans have an important role to play in our free market economy, the payday lending law needs reform. These basic reforms will decrease default rates on these type of loans, which will be good for the lenders as well as the borrowers. In turn, the reforms will be good for our local economies by allowing more people to stay economically engaged without grossly damaged credit. The bill provides a change that creates a more balanced and free market version of payday loans that will benefit Wisconsinites.